Welcome to our channel. Today we will talk about the exciting and often unpredictable world of trading in the stock market. If you are interested in investments, financial markets and want to learn the secrets of successful trading, then you have come to the right place. Trading in the stock market is the process of buying and selling stocks, bonds and other financial instruments for profit. This is a dynamic and high-risk area where every decision can make a huge difference to your portfolio. In our video, we'll walk you through the key principles of successful trading that will help you succeed in the stock market. We will cover such important aspects as market analysis, risk management, strategy selection and much more. Get ready for an exciting journey into the world of trading, where every day brings new challenges and opportunities. We will share our knowledge and experience with you to help you become a successful trader. Don't forget to subscribe to our channel and hit the bell so you don't miss new videos about trading and financial markets. Let's start our dive into the secrets of successful trading in the stock market. Advertising. All the time thinking about finances and how to increase your income? There is a way out. Bybit, the best platform for earning and investing. And with the promo code in the description you will get $1,000 for your first trades. Link in the description. Chapter 1 Introduction to Trading the Stock Market. Stock market trading is the process of buying and selling financial instruments, such as stocks, bonds, futures and options in order to profit from changes in their prices. The core principles of trading include market analysis, informed decision-making, risk management, and emotion control. Traders can use various strategies such as day trading, long-term investing or arbitrage to achieve their financial goals. People trade for a variety of reasons. Some see it as an opportunity to earn extra money or create a permanent source of income. Others are interested in financial markets and want to deepen their knowledge in this area. Trading also provides the opportunity to work independently and manage your time flexibly. Trading can provide people with the opportunity to capitalize on changes in the prices of financial instruments. It can also be used to hedge against inflation or to diversify an investment portfolio. In addition, trading can be an interesting and exciting hobby that allows you to develop your analytical and decision-making skills. Chapter 2 Important Concepts and Terms in Trading. Shares are shares of ownership of a company that are traded on the stock exchange. Ownership of shares gives the right to receive dividends and participate in the management of the company. Bonds are debt securities issued by companies or the government to raise capital. Bondholders receive interest payments, coupons, and a return of principal at maturity. Futures are contracts to buy or sell assets, such as raw materials, currencies or financial instruments, in the future at a predetermined price. Futures are used for risk protection or for speculative trading. A long position is a position in which a trader buys an asset in the hope of its growth in price. The trader expects to profit from the increase in the value of the asset. A short position is a position in which a trader sells an asset that he does not have, with the hope that its price will fall. A trader expects to profit from a fall in the value of an asset and buying it at a lower price. A stop-loss order is an order that a trader sets to automatically sell an asset if its price reaches a certain level. A stop-loss order is used to limit losses in the event of an unfavorable price movement. A take-profit order is an order that a trader sets to automatically sell an asset when its price reaches a certain profit level. A take-profit order is used to take profit and close a position. Chapter 3 Market Analysis. Fundamental analysis is a market analysis method based on assessing the financial performance of companies and other factors that may affect the prices of financial instruments. Fundamental analysis includes the study of income statements, balance sheets, dividend policy, the competitive environment and macroeconomic factors. It helps traders determine the fundamental value of an asset and decide whether to buy or sell it. Technical analysis is a market analysis method based on the study of price charts, trading volumes and various technical indicators. Technical analysis assumes that the prices of financial instruments reflect all available market data and repeat in certain trends and patterns. Traders use charts and indicators such as moving averages, stochastics, RSI and MACD to determine trend direction, support and resistance levels, and entry and exit points. Both methods of analysis have their advantages and disadvantages, and many traders combine them to make decisions. Fundamental analysis helps to understand the fundamental factors that affect the market, and technical analysis helps determine the optimal entry and exit points. Chapter 4 Risk Management. Proper risk management is one of the key aspects of successful trading. It allows the trader to protect his capital and minimize losses in the event of adverse market events. Position sizing and stop-loss levels are important elements of risk management. Position size determines how much capital a trader is willing to risk on each trade. It is generally recommended that you risk no more than 1 to 2% of your capital per trade. Setting stop-loss levels allows you to determine the maximum loss that a trader is willing to allow for each trade. A stop-loss order is activated when the price reaches a given level and helps to limit losses and protect capital. Portfolio diversification is a strategy in which a trader allocates his capital among different assets or instruments. This allows you to reduce the risk associated with specific assets or markets. Diversification can be achieved by investing in different companies, industries, regions, or asset classes. It helps to smooth fluctuations in the portfolio and protect against potential losses. In general, proper risk management helps a trader to retain capital and earn stable profits. It includes position sizing, stop-loss levels, and portfolio diversification to minimize losses and protect against adverse market events. Chapter 5: Choosing a Trading Strategy. When choosing a trading strategy, a trader should consider their financial goals, experience level, time available, and comfort level with risk. Here are some of the popular trading strategies. 1. Long-term investing. This is a strategy in which a trader buys assets with the aim of long-term growth and retention. It is based on fundamental analysis and requires patience and a long-term view of the market. 2. Short-term speculation. This is a strategy in which a trader tries to profit from short-term price fluctuations. It may include techniques such as scalping, day trading, or intraday trading. 3. Position trading. This is a strategy in which a trader holds positions for a long time, from several days to several months. It can be based on fundamental or technical analysis and requires patience and the ability to manage long-term trends. 4. Trading based on technical analysis. This is a strategy in which a trader analyzes price charts, indicators, and patterns to make decisions about entering and exiting positions. Technical analysis can be used in a variety of trading strategies, including short-term speculation and position trading. 5. Trading based on fundamental analysis. This is a strategy in which a trader analyzes the financial performance of companies. Fundamental analysis can be used for long-term investment and position trading. It is important to choose a strategy that suits your goals, trading style, and risk level. Many traders combine different strategies and analysis methods to achieve the best results. Chapter 6: Practical Tips for Successful Trading. Develop a trading strategy and stick to it. This will help you avoid random and thoughtless decisions. Set limits on your losses and profits. This will help you control risks and avoid big losses. Don't try to predict the market. Instead, react to the current situation and analyze the data. Don't trade on emotions. Try to remain calm and rational while trading. Use stop-loss orders to automatically close a position if the price reaches a certain level. This will help you protect your profits and limit your losses. Don't overestimate your skills and don't risk more than you can afford to lose. Be realistic in your expectations and manage your capital with care. Constantly learn and improve your skills. Read books, attend seminars, and connect with other traders to learn new trading strategies and approaches. Keep a log of your trades. Record your thoughts, decisions, and results so you can analyze your mistakes and improve your strategy. Don't be afraid to take losses. It is important to be able to break away from losing trades and move on to the next opportunity. Don't forget to diversify. Spread your capital across different assets and markets to reduce risk and increase opportunities for profit. Chapter 6: Summing up. In this video, we've covered a few of the key secrets to successful trading in the stock market. Here are the main results. 1. Trading psychology. Emotion control and stress management are important aspects of successful trading. Don't let your emotions influence your decisions and learn to remain calm in any situation. 2. Goal setting and trading planning. Develop a trading strategy and stick to it. Set limits on your losses and profits to control risks and avoid big losses. 3. Learning and continuous improvement. Trading is a continuous learning process. Read books, attend seminars, and connect with other traders to learn new trading strategies and approaches. 4. Using stop-loss orders. This is an important tool for protecting profits and limiting losses. Set a stop-loss order to automatically close a position if the price reaches a certain level. 5. Realistic expectations and money management. Do not overestimate your skills and do not risk more than you can afford to lose. Be realistic in your expectations and manage your capital with care. 6. Keeping a trading journal. It is important to write down your thoughts, decisions, and results in order to analyze your mistakes. 7. Diversify. Allocate your capital across different assets and markets to reduce risk and increase opportunities for profit. By following these tips, you can increase your chances of successfully trading in the stock market. Remember that trading is a process that requires constant learning and skill improvement.